And I think as a few more people start to fill in, the basic structure of today's presentation, we're going to have in the first half, Eng, our CEO, is going to be presenting the actual investment opportunity. And then in the second half, we're going to move on to a live QA portion. For those of you that still have questions or concerns, you can post those in the chat, and we're going to be pulling from there toward the end of our presentation. And then this presentation will be recorded and should be available. We can send it out to anyone that either hasn't seen it or would like a copy of it. And yeah, if Eng, if you wanted to introduce yourself, or if you wanted to hand it off to some of the other people in the chat.
Actually, let's introduce a few of the folks on the partners in the chat first, and I'll start with my long introduction.
Okay, great.
Travis, why don't you introduce yourself?
Oh, sure. My name is Travis Gibson. I'm a general partner on this deal. I'm the CEO of Freeman Equity Group, and
Travis' connections is a little bit poor right now. We got Hoshi as well. Hoshi, can you introduce yourself?
Absolutely. Hi, my name is Hoshi Dastur. I'm a full-time investor based in San Francisco. I'm a general partner on this deal as well, and excited to be here.
And Will, if you're here.
Hey, how's it going, guys? My name is Will Gibson, also general partner with Tuesday Capital. Previously was a financial analyst at Apple. Currently looking for another position in tech, but I've been investing passively for the past few years in syndication deals just like this, and this will be my second deal with Tuesday Capital. Excited to be partnering with everybody on this deal.
All right, I'm not going to introduce everybody because I just wanted to just hit on some of the folks that had some invites. I know the rest of you guys might know some of the guys on our team in Tozy, Sherbish, and Jared. We have slides on the team as well. So I'll start just by introducing myself. My name is Eng Tang, CEO and founder of Tozy Capital. This is one of my favorite deals because it's really my bread and butter. It's high cash flow, tax advantage investing in workforce housing, C-class neighborhoods that are pretty resilient, putting cheap debt and getting high cap rates and high cash returns. So this is going to be this is our sixth investment in Tozy Capital, and some of my partners here have invested once or twice with us before. And hopefully you guys will be participating in first or second time. I know some of you guys are potentially will be repeat investors. So I wanted to start talking about COVID-19. I think this is something, if you're investing in any deal, any investment now, you have to talk about this head on. And of course, this is a fluid situation. My thoughts on this in April were very different than what it is now. But the big picture as it stands is Fed actions has had a direct impact on real estate. The $4 trillion of liquidity injections have really inflated asset markets. You see that in the V-shaped recovery in the stock market. And you see that in backstopping of liquidity in corporate bonds and other mortgage-backed securities. What I've seen on the boots on the ground is real estate in some areas have actually gone up in price as financing has been cheaper. And a lot of people that are buyers are still remain on the hunt, but there's fewer sellers. While cash is king, cash flow is just as good, and a lot of capital is seeking safe assets like bonds, as well as higher yielding assets like multifamily, stabilized multifamily, which I believe this is can be classified as such. The Fed rates have cut to nearly zero, and that's really lowered our cost of borrowing. I bought something close to around this price point a year ago, and our cost of borrowing was 4.5%. what our cost of borrowing right now would be 3.3%. So our spread is much higher now than it was before, giving us a lot of buffer for increased uncertainty. And finally, real estate is a great hedge against inflation, both on my asset protection, inflation side, but also as long-term debt gets cheaper over time. You will owe the same amount over the long term, and the value of the dollar, as it goes down, your debt will be cheaper in the future. So I'm looking to place cheap long-term debt on as many assets as possible, as debt is really at an all-time low. So Independence 3 is a collection of 3 apartment buildings in Independence, Missouri, a suburb of Kansas City, Winter Place, Meadowbrook, and the Hudson. So we'll go over investment highlights, offering summary. I'm going to talk briefly about the market, location, and I'm going to skim over the properties. There's a lot of dense words and numbers here, so I don't want to focus too much on that because I'll just be reading off things. I really want to just tell the story of why I love this investment, how we're going to make money, and answer as many questions as possible for this attendance group. And finally, we'll end up with numbers to briefly go over our track record and the team, and open up to FAQs and Q&A. Oh, sorry. So the major investment highlights of this deal is, one, there's a COVID pricing discount. And logistically, during the time of negotiations and acquisition, everyone was grounded. There was very few people coming from the West Coast and the East Coast, which is where most of institutional money and capital markets are looking. A lot of times we are competing against New York buyers, institutional buyers, and they have a whole process where they need to get boots on the ground, and logistics was very difficult in this time. So we actually got this property at 10% below the list price, which is actually pretty unheard of for this type of asset. Typically, we've seen sell to list price at slightly higher, given increased competition. So this has allowed us, with our inherent logistical advantages, given our regional partners, to get that 10% discount. Because with that 10% discount, we also have a high, in addition to the high physical occupancy of the units, around 98%, we are projecting a 12% cash flow to investors. That's a year 1 cash flow, and that's an average year 5 cash flow. Finally, we were going to get favorable financing as well. We have secured 3 separate Freddie Mac agency loans, around 77% LTV on a 10-year term with 3 years interest only, providing for a healthy buffer of above 2. It's actually 2.5. And I'll go into some of these terms in later slides if you guys aren't familiar with what these mean. Another point of interest here that I really like is the fact that the sellers recently renovated around $1.7 million in CapEx. Why this is important is because we want to make sure we have an understanding of how much improvements we need to make, foundation improvements, and future capital outlays we might have. And so by having an asset that's recently renovated, and these renovations typically don't really generate a lot of extra rental income, they just are necessary for the longevity of the property. We believe that we're not going to have too much CapEx expenditures in future improvements, and we're going to be carrying $1 million of CapEx in general for improvements as well as value add. So speaking of value add, the sellers have implemented value add measures that we will continue to implement over a third of the units. These measures have increased rents even the past few months. In fact, during the course of the ownership, during this contract, the sellers have increased NOI by $50,000 by just implementing on new lease turnovers. Now, that's not to say that we're going to be increasing rents on the majority of the residents. In fact, for people who are staying on as resident and extending the leases, we're not increasing rental rates at all. Finally, one thing I really like is that we're going to have an operational efficiency where Belmont, one of our sponsors, will be taking over property management of the 3 assets with their own in-house property management firm. This will bring us depth of experience and cost-saving measures. In addition, we love this property so much that we're bringing $1 million or 15% of the equity contribution. So as a recap, this is a 426 unit property in Independence, Missouri, with light value add and high occupancy. So this is really the money slide for you guys, the offering summary. I think it highlights why we love this deal. The business plan, I'll go into that just real quick, is to continue the value add improvements, to conservatively underwrite the fact that we're not increasing rents, that we're going to be driving up rental income over 3 years by 10%, based on these proven models of CapEx expenditures and premium units. We're going to be improving some of the common area amenities that allow for additional rent increases, but these won't be implemented until end of year 1 and then close to year 2. And this is going to be more accommodating to the current profile investor base. September, we're going to look at September funding deadline. We do expect this offering to sell out quickly, and we're aiming to close quickly after due diligence, financial due diligence, ending September 8th. And we expect to close in September. I'll go through the numbers real quick. So average cash and cash. So that's what you should expect from investors. And you can see based on a 100K investment, what you'll be looking at in terms of your return profile. So you'll be looking at, this is obviously projected. We're projecting based on our conservative underwriting. If we hit better marks than what we're conservatively underwriting, we should expect these numbers to go higher. But based on our model, we expect year 1 to get you 11.7%, year 2, 12.1, year 3, 14.0. And then after the 3-year IO period ends, we expect that to decrease a little bit. And then year 5, to not only to add that cash flow, but on a exit of 6.5 cap exit. We're buying at a 6.3 cap. So we're confident we can sell at a higher cap rate, which is to say that we're going to sell at a more stabilized property listing. So the purchase price is $21.3 million. The preferred return is 8%, and the LP-GP split is 80-20. So what preferred return means is for the cash flow that's coming off this property, the investors are getting the first 8%. If the property generates 10%, say for a year, the extra 2% above that gets split 80-20, 80 to investors, 20% to the management team. And this, I really like this structure because it allows us to align the economic incentives to make sure that we have a good floor for the investors, but we reward ourselves when we exceed returns. And you guys will be participating heavily in that reward as well. So we're raising $6 million for this. And I can say that we're close to $4 million in capital commitments already. So we're close to, so I expect after this webinar, after next week, to finalize the capital raise or commitments up to $6 million. I'm going to go into Kansas City Metro and why I love it. And I have lots of properties in Kansas City, so are my partners. So one thing that you try to look for when you're looking to a market, you want to look for population growth, job growth, and crime decrease. These are 3 fundamental factors that makes real estate an inflation, both something that has upward inflationary pressures from rents, but also makes real estate just invaluable. Now, overall, America seems to be, the migration patterns in America shows that it's a lot of Rust Belt cities. And so there's actually a lot of cities in the Midwest that I probably wouldn't necessarily invest in. But Kansas City seems to be bucking the trend where a lot of people come from different areas like St. Louis into Kansas City. And you can see that even in Ohio, where Columbus has a huge population growth, but Cincinnati and Cleveland has population decreases. Another reason why I like Kansas City is overall the diversity of employment. It's the number 6 tech talent in America, mostly centered around healthcare tech. And finally, it's really a stable market. That's one thing I really like about this, and you can see why that matters given the current economic climate. So there's a bunch of KC stats here. I'm not going to go into them too much because I would just be talking a bunch of numbers. Hopefully you guys will get these slides or have already seen these slides. A lot of things really center around the fact that you're seeing these above national average growth. And there's a recent article on August 16th highlighting that Kansas City is second in metropolitan area, only second to Phoenix in terms of rent growth. So this is surprising to me, but not really that surprising given the fact that one thing we're seeing in really high cost markets like Los Angeles, New York, San Francisco is more rent negotiations, lower rent to rates, mostly because rent prices have gone up dramatically in the past 2 to 3 years in these markets, while Kansas City haven't seen that growth. Kansas City, I like to say, is very steady. During the last economic downturn, you saw pretty much a little bit dip, but not as much as what you saw in San Francisco, where you saw a big cycle. So we don't have necessarily the boom cycles of going up, but we don't have the bust cycles of going down as well. Livability is a big part of this as well. A lot of people are moving with new work from home, sort of being potentially the norm going forward. People are moving to lower cost of living areas. And then jobs are also moving there as well because you see lower costs of talent. Finally, I want to talk about Independence, Missouri, because that is the city that we'll be investing in. It is a much smaller suburb, but most of the current tenants in Independence actually work in Kansas City. It's only a 15 to 20 minute drive to Kansas City, and it's a healthy household population income as well. There's actually a lot of new economic development happening in Independence, and Independence and Kansas City constitute a bicameral representation of Jackson County, meaning that there's a lot of government centered in Independence in addition to Kansas City, and they share it in co-equal branches. So just give you a highlight of how close Independence is and how close these properties are. You can see Kansas City, downtown Kansas City being right there, and these places being 15 to 20 minutes a drive away. And you can see that we're pretty close to both the Kansas City Chiefs and Royals. And as soon as those sporting events happen again, hopefully next year, I think that'll drive further in development. Independence, Missouri is centered around like any other suburban area. These places are located near schools, as well as shopping districts that generate a lot of jobs and income. Even during this time, Independence, Missouri is definitely it's pretty open still compared to California. I think that's a bit of its own nature of culture and whatnot. But you do see a lot of job growth in that specific region close by. So I'm going to go over the properties real quick. And I'm going to highlight some of the things I really like about this. One, obviously we talked about high occupancy. We talked about the in-house property management. We talked about the renovated, newly renovated asset. One thing that we're going to be adding is this RUBS. Essentially, is billing the tenants for the utilities, and we're not going to do that for people who are current tenants. We're going to do that for people who are coming in new, and the current owners have already done that to around 10 to 15% of the tenants, and with great success and increased NOI on those ones. We have a very good unit mix as well, and I'll highlight those unit mix, which gives us a good buffer to both have a variety audience of workforce housing and family units, as well as folks that don't have families. So you can see the average portfolio mix, the average year built is 1972. And one thing that you want to highlight, one thing you want to see with properties that are vintage 1976 and older is that asbestos has been taken care of. So the good news is that the sellers have already taken care of the asbestos abatement that was done in the last sale, and we've been cleared of anything from environmental underwriting so far. And in fact, no, we actually finished that 2 days ago. So 426 units, and the biggest being Hudson, and the average rents being around 666. So that's really the floor of where rents are in Kansas City. And this is squarely a C-class property, which has a lot of benefits given the current COVID situation. So the unit mix here, I'm not going to highlight too much of this because there's just a bunch of, but you can see that we both have studios, 1 bedrooms, 2 bedrooms, as well as a few 3 bedrooms. So I'm going to go into Rented Place. So one thing we like about Rented Place is that you're seeing a 5% rent increases based on the minimal capital spend on turnovers over the past 3 months. So this has been happening during the contract period. When we get into contract, we try to get as much transparency and access to what the sellers are doing. And we want to see that the business plan that we're implementing can be executed upon and have the legs and momentum even during this current pandemic period. So a lot of the details are here, and you can see some of the resident charges. We have a pet fee, a late fee, deposit fee, and trash fee. And we're going to add valet trash in some cases. This is a unit mix and amenities. And here's Rented Place. You can see it's right across the street from Van Horn High School and near Charles Long Park. We're going to go to Meadowbrook next. It's second smallest property, second largest property, 113 units. Another reason why I like this, as well as the whole portfolio, is that all these units are below market now. We're currently some market projections as much as 9% below market. And our business model is to increase the NOI of the rent by 10% over 3 years. So even if we just get to market rent in year 2, we're going to be ahead of the game, which it's just going to be mostly about getting people, new tenants on the market rents. And as we get turnover, which we don't necessarily want to do now, we're optimizing for rent collections and occupancy. As we get turnover, we want to make sure that we improve the units enough, not with too much capital expenditures, but enough. And we have a blueprint for that from the current owners. Sorry about that. So Meadowbrook is, it has a similar type of interior finishes as the other properties. And you can see some of these pictures are the new finishes that the new owners have put together, which has been roughly around $2,000 to generate a $35 to $50 rent increase. So that generally has a pretty high ROI given the impact on NOI growth. And the unit mix for Meadowbrook, and you can see where Meadowbrook is right next to 2 middle schools and an activity center. Finally, Hudson. Hudson is our largest property at 253 units. leases have been increasing by 2.6 over in-place rents based on just turning over. So they're actually not even adding any premium units, and the one bedrooms are actually $62 below the competitive set, and the two bedrooms are $103 below the highest performing set. So we have a lot of room upside to grow. We're not going to take advantage of that now, only on turnovers, but for anyone essentially extending their leases, we are not going to push for any rent increases. So that's details of the Hudson, which has a clubhouse as well, and the unit mix of the Hudson. It's actually quite a bit of 2-bedroom properties, and that really highlights the demographics of the Hudson, as well as all these 3 properties. One thing that I want to highlight with these properties is we did do a demographic survey of both the jobs and the people who live here. And what we've seen is that this is a very Hispanic community. And given the nature of this community, we see a lot of folks live close to their family members in close proximity to them. And so we both have a resilience of many working age people in each unit for the 2 bedrooms, as well as families that have share strong retention and referrals by having their relatives, the cousins, live across the hallway. And we've seen that time and time again, that a lot of the new tenants come in by the just simple case of, oh, my family lives there, my other cousins live there. We're gonna, as we grow our family and as we we want to be close to them. And this is really a great opportunity to keep and focus on that economic base. Another thing we saw with the job profiling is that a lot of them are essential workers, and they haven't had a huge economic hit so far. Beyond the economic impact of job loss potentially occurring on any population center, in fact, across America, we know that a lot of the tenants were already on some portion of government assistance. And this government assistance is pre-COVID government assistance, meaning that they're getting assistance beyond what the unemployment checks that were supposed to run out in July was supposed to give. And that's really given a boost to rental rates. And I'll highlight what rent collections looks like in a bit. So this is the Hudson. It's a fairly large community as well. And I want to highlight our on-the-ground management. Belmont Management Group will be our on-the-ground management. They are partners of us, and we've partnered them on a few other deals as well. They have 5,000 units, over 120 properties in mostly the Midwest and Texas as well, Colorado, and they're centered in Oklahoma. So they have a lot of experience specifically managing workforce housing and C-class properties. And I think that's really important because they have a lot of expertise understanding retention and how other properties that they hold have been maintaining and marketing to this class of tenants. And I just want to highlight also that, with any transition, there might be some things that might be surprising. One thing that we're trying to do is actually hire some existing property management personnel onto Belmont. So Belmont will actually be hiring some of the on-site personnel so that we can have a seamless transition for the tenants. So I'm going to go to the numbers, and there's going to be one thing I want to highlight is both what this means to the investors and what this means for these properties. So for the investors, I really want to highlight the fact that this is an 8% preferred return, which is above average. You see most syndications provide only 6 to 7%, an 80-20 split, which is also above average. But we do have a secondary hurdle where if we get above 20% AAR, we will do a 50-50 split. And that's going to align our incentives to make sure that we get above that hurdle. When you get above 20% ARR on a 5-year hold, that means you're doubling your money. The investor cash flow, average investor cash flow would be 12% as shown before. Equity multiple is 2.15, and the average annual return is 23%. So the financial sources and uses, we're getting a $16.3 million debt across 3 Freddie Mac agency loans. That will be a 3.3% interest rate and a 3-year IO. And interest only period is really beneficial to both give heightened cash flow during these first few years, but also interest is always tax deductible in commercial properties. We're doing a 10-year term on 30-year amortization. And you can see the fees and acquisition uses here. Most of these fees are mostly used for operations and hiring, integrating the asset management and tax reporting. So you can see the invested cash flow as I highlighted in the previous, in the offering summary. One thing I want to highlight here is on your first year of investment, we will be doing a cost segregation study. And based on that cost segregation study estimate, I believe we'll get close to 50 to 65% of your cost basis as a first year loss. That's going to be a phantom paper loss. What this means is if you invest $100,000, you could get close to $65 of losses the first year. You will get $11,000 of cash flow the first year. And so that will wash out your cash flow, and you can carry that loss forward, or you can use that for any other passive income. Net effect is if this is your only investment, you will pay no taxes for the foreseeable future until the sale event. And even then, ideally, you're planning ahead with additional investments or potentially a DST or a 1031 exchange. Sorry, my slide keeps getting stuck. All right, so the pro forma, I'm not going to highlight too much here. One thing I want to highlight though is that taxes is usually centered around an off-cycle year, and we don't expect the tax to be readjusted in the first year. The expense ratios are around 50 to 55%, 55%, and that's typical for a C-class property. One thing I like about this property is its resilience. And when I did an sensitivity analysis, we did both the exit cap rate analysis and highlight the fact that, you know, we're expecting to sell at a 6.5 cap. We're buying at 6.3. Properties of this type of asset sell typically for around 6 to 6.25 right now. Given further economic improvements, that could compress. Given cheap financing, that could compress even further as well. So those would be the reasons why those things happen. Another thing that I like to model is the vacancy stress test. Right now, we're forecasting around 8% vacancy, both that's physical and economic vacancy. And if our break-even point is around 31%. And I didn't highlight DSCR, but the average DSCR is 2.5. And you can see here, the first year DSCR is 2.7, second year is 2.78. Third year is 3. Freddie requires right now a 1.5 to underwrite this deal. We're well over that. DSCR means how much you're getting in net operating income, your income divided by your debt service. So if you're at 1, that means you're just breaking even. This is inclusive of taxes and all the property management fees and all the fees that we listed before. If we're at 1, that means we're at a 70% occupancy, or 69% occupancy. So the fact that we're at a 2.5, 2.7 in the first year DSCR, we have a very healthy buffer for increased vacancies and bad debt collection. Another thing I've been tracking is August collections. August collections for these properties have come in on par with July. So this was something that I was very interested in, and I'm happy to say that we are on par. When you look at what the National Family Housing Council has conducted in terms of 11.4 million units across the country, they're seeing a slight dip in August, a 1 point dip, or less than 1 point dip in August. Now, this is of all markets, and I want to highlight the fact that this isn't of just Kansas City, and I believe Kansas City is one of the more resilient markets because of this non-cyclical nature. What I'm seeing in the market right now is a lot of this rent collection issues are happening in LA, San Francisco area, really B and A class areas and tier markets that have much higher rents. You know, someone who is paying $3,000 for a 1 or 2 bedrooms building and they're not in an office or a job that can be work from home, or they've lost a job, those guys are the hardest hit. People who in workplace housing, people who are paying $60 to $70 a month for housing, the alternative is homelessness, unfortunately. We're not evicting anybody, of course, and that's part of the eviction moratorium, but only 5 people are on payment plans, and those payment plans are typically resolved within a month. And we've done a lot of rent analysis as well compared to the other properties and we see that ours is around 8 to 9% below market rent. I talked a little bit about the depreciation benefits. Again, it's gonna be around 55 to 65% bonus depreciation. And you get the highest bang for your buck when you get high leverage, you have low land value, because only non-land value is depreciable. The land is not depreciable. Kansas City, I like to think, especially Independence, land value is around 5%. In San Francisco, it's close to more than half, and you can't depreciate that. In addition, the higher leverage, bank and debt does not share in depreciation, so that goes squarely onto the investors. So for the first 4 years, you probably can see 0 taxable income and comparable to non-tax advantage earnings of 18%. So this is the ownership structure. You'll be investing in Swoop, Winter, Cunningham. It's really an anagram of these 3 names and their addresses. And we, the sponsors, will be co-investing with you and as B-class members on the management. And we will be managing the properties as well as guaranteeing the loans. So for the investors, you have no responsibility, no liability, and no responsibility. In addition, we have 3 separate assets holding each individual property that creates better buffer for other asset protection issues as well. So I'm going to briefly cover the team before we go into FAQ. So, as I talked about myself, Hoshi's on the call and Travis as well. But I wanted to highlight our partners that aren't on the call. FTW is our local on-the-ground boots on the ground, Parker, Logan, and Corey. They have a wealth of experience in Kansas City market, and they focus solely in Kansas City. Belmont are also partners, and they have a much deeper experience set. In fact, Ryan has close to $250 million of assets under his belt and has a combined 90 exits amongst us 3. I have a couple other partners on the call, and Jared's our host. And our track record speaks for itself. Belmont, FTW, and Tozy have $400 million of assets under management. We have 7,500 units under management and 120 properties. So these are a mix of small and large properties, just like these 3 assets themselves. And we've had 90 profitable exits. Now I can go to terms and conditions, to the terms and definitions. Hopefully you guys can review that. I will talk about the most frequently asked questions real quick, and then we'll go into the Q&A portion of this. So this is a 506B offering, which means that we can accept non-accredited investors. So you have to be sophisticated, but hopefully through this webinar and other learnings that we can qualify you as sophisticated. You can invest with a self-directed IRA, and a lot of folks do that. And I would recommend looking to solo 401ks if you guys want really a really great tax advantage nature to invest with your retirement funds. Typically, we could do a 1031 exchange. However, given the timelines, we want to make sure we're not going to be able to accommodate it now. I think given the timeline, I don't think we'll have, because usually you have to set up a tenant in common, and we usually need advance notice. But I do believe that we'll be finalizing the raise pretty quickly. So unfortunately, we're not going to do a 1031 exchange for any potential investors. So a question I get asked a lot is, what if I need my capital earlier? So real estate is typically an illiquid investment. There's pros and cons to that. The pro, of course, is that we don't have to sell it during any downturn or economic distress. The cons being that you can't really get your money out of it. But the nature of this investment is that you're buying fractional shares of this investment. And the people, it's going to be like a pre-IPO stock. There's going to be a secondary market. And if, for example, if you invest 100K on year 2, you said, and a life event happened, I need to exit. It will be up to you to negotiate that. If you come to me and say, I want to sell my shares for $120,000, I bought it for 100K, I would probably buy it. That's gonna be a really great deal. I'm 2 years closer to the exit point, and based on the appreciation of the property, we do expect that will probably be a very good deal. Of course, if I don't have the capital, or if you want a more, then you're going to be really the biggest audience of people who could buy from you or trade it would be the other investors. When do I expect my first dividend check? You should be getting it in the first quarter of 2021. We have in almost all of our investments paid earlier than expected, but we want to just give us enough time to make sure we have all of our accounting in place, and to have really the good understanding of the ins and outs of the properties. The distributions would be paid quarterly, although in some cases we're looking at monthly as an option, although just to set our expectations, it will be quarterly. The minimum investment is 100K. However, if you are new, I do want to make sure that we can accommodate folks that might want to come in at lower amount, or can only come in a lower amount. We really believe this is a long-term partnership. And I know that a lot of the investors on this deal would be repeat investors. So I want you guys to come in as comfortable as little as possible, or not as little as possible, as comfortable as possible. Although we do expect most investors to come in around 200K. We'll be sending monthly updates and quarterly webinars. So what happens after this webinar? So after this webinar, we'll be providing a poll in addition to a link to get your interests. We will be sending subscription docs by the end of the day tomorrow. You review those docs, take your time to review those docs, and we'll be closing on the property in mid-September. But we'll be asking for funding before that. And it'll be a first come, first serve, unless you told me, or unless you give me an indication of your soft commitment already. One final thing I want to highlight is why are the sellers selling? Like in most things, it's about the taxes. They've taken a lot of the tax benefits already, and it's at the end of their business investment lifecycle. They're looking to tender or exchange to another property, and that would probably be our answer when we're selling at year 5 as well. So Jared, I want to open up to Q&A.
Yeah. So as I said, right now we're going to be moving on to Q&A. We do have a few questions already in the chat. So if you have any questions, feel free to post there. I'm going to be asking those questions chronologically from the time they were posted in the chat. But beforehand, I think Sarvesh does want to release a quick 1-question poll to the attendees right now, so we can gauge overall interest, and he should be able to send it through Zoom, and then after that we'll be going on to Q&A. Give everyone few more seconds. Okay, great.
Competing.
So right now, as I said before, if you have any questions regarding the property, anything with like the financials, feel free to post within the chat. I'll be going through those.
Before we begin, I know I know a lot of you guys are equity investors as well, and I love the concept of diversification. Travis, one of our general partners, has a lot of great thoughts on that. Travis, do you mind sharing your thoughts on diversification and capital gains?
Absolutely. I'm actually going to just go audio. My connection is not great where I'm at. But what I want to talk about is in the wake of the COVID-19 pandemic, the Federal Reserve has been printing money like crazy. Everybody knows this, to the tune of $6 trillion in stimulus payments to individuals and businesses, in addition to, as Ang mentioned earlier, backstopping the bond and stock markets. This has led to a pretty significant rally in the overall market, with the Dow, S&P, and NASDAQ all reaching record highs. My clients and I have seen considerable gains since the 30% pullback in early March. And if you're an investor in equities, I'm sure you've seen a gain that's pretty significant as well. However, we all know no rally lasts forever. And with the election looming large in November, we can expect to see inflationary pressures in what I predict the very near future. So you might be wondering, so what does this have to do with multifamily real estate? Well, I'm advising the investors that I know to start considering diversifying their risk, taking some of their capital gains from increases in their equity positions and begin investing in cash flowing assets, such as multifamily real estate. Now, if I'm being honest, the short-term gains in the market have been incredible. However, how sustainable are they long-term? When you keep in mind that the stock market itself is 3 times as volatile as the real estate market, when you actually adjust for inflation, you see that multifamily real estate actually outperforms both the S&P, the Dow, and the NASDAQ. So it's in my personal experience, from what I've seen from investing in real estate for over 20 years, if you're really concerned with building long-term wealth, you have to really seriously consider how much of your current net worth has to be deployed into cash flowing real estate. So you don't have to take my word for this. I encourage anyone, go ahead, run the numbers for yourself. And you will definitely see that over any sustained period of time, any 20-year period of time, this multifamily real estate outperforms any of these index markets. And you know, I'm a big Tesla supporter. So
Yes.
yeah, I'm a big Tesla supporter, and I've actually shaved some of my Tesla positions to actually invest not only in this deal, but in other multifamily deals. So if I'm willing to do that with the run that Tesla has, you might want to consider it as well. And that's it for me. I'll pass it back to you, Jared.
Awesome. Thank you so much for that, Travis. Yeah, so I guess we're going to go back to the chat and go over some of these QA portions, questions. Now, some of these may or may not have already been answered. So, Eng, if I answer, or if these have already answered, feel free to just either add more detail or at least go to the slide. But our first question, what percentage of the occupied apartments are paying rent as of now? Due to COVID, are they able to defer the rent payment?
So we're doing a soft touch on this. We're not telling people they can defer. That would be the unwise. We are seeing a 95% rent collection on our properties, 98% of the occupancy. So that is year over year, just half a point below where it was last year. So it's not really uncommon to have not 100% rent collection, and only 5 people are on payment plans, as I mentioned.
Okay, great. I think this may have been answered in the slides already, but can you give us a distribution on the apartment types, for example, 1, 2, 3 bedroom? And what is the typical rent on average for each of these bedroom types?
So I did mention that in the deck. So I think that was answered beforehand. So I'm not going to talk about that mix. The mix is right here. But the rent spread between a studio and 3 bedroom or 2 bedroom is around $200 to $300. The studio going as low as $450, and the 3 bedroom going as high as $1,050.
And what type of tax documents will you be issuing to us each year?
Good question. So we'll be sending a K1 before March of 31st every year. And this K1 will highlight both the profit and loss to you as a shareholder of this investment. And that's where we'll give the first year huge bonus depreciation loss, around 55 to 65% of your cost basis of your investment as a loss the first year.
All right, great. The next question is there any depreciation every year that will build?
Yeah, so not only will we get that first year huge depreciation benefit, which typically is 20 to 25% of the whole whole depreciable asset, but for the remainder 75%, you get a straight line divided by 27.5. So we expect around 3 to 4% in addition to every year if depreciation losses, 3 to 4% of your cost basis.
Okay, great. Another one, could you clarify the reason and source for the depreciation where the investors can claim close to 60K in losses?
Yeah, so in 2017, Trump passed a new, very favorable tax bill that allowed any asset, real estate asset that had really inventory that could be depreciated within a 5 to 15 year life cycle to take it in the first year. And that's what we call bonus depreciation. That includes carpet, cabinetry, wiring, HVAC, and whatnot. And given the fact that these assets are a bit older in vintage, we expect, based on doing this on every other property we've bought before, to have a significant portion of that to be this year 1 bonus depreciation. So we'll pass it on to the investors through your K1s to highlight that huge loss basis. And this is one of the reasons why I love real estate in general, that a lot of it's going to be about a deferral of taxes. You defer, and hopefully if you've set it up right on the exit, you never pay it.
Okay, great. Next question. I'm looking for investments with more conservative 65% LTV. How would I get compensated for a higher risk with this investment? Thanks.
So when we look at properties that are lower in LTV, that's usually necessitated by the fact that you're buying at a lower cap rate, which means that if you're leveraging at 80% or 75%, you can't really get a DSCR of 2.7. Conservative underwriting means that you're buying conservatively as well. And you're buying usually lower cap rate, 4 to 4.5 cap rate properties. And so the heightened risk of this is offset by the fact that DSCR is already really high. And you really just go look at DSCR as really a great foundation of understanding. The pro and con of high LTV also is that because the 65% or in this case 77% does not get shared with the lending agencies in terms of depreciation, you will get an outsized benefit to your depreciation benefit.
Okay, perfect. Another question, just wanted to confirm that the loan is interest only for 3 years and not 2 years as the offering summary says.
Yeah, so it's 3 years now. So initially it was 2 years, and rates have gone down over time. Our reserve requirements gone down over time. And that's a function of more detailed underwriting into the properties. And so these are the terms that have been fixed for us in the last 3 weeks.
Great. Next question: as the value being added is limited, where is the appreciation coming from?
So we're seeing only a 10% value add strategy in the first 3 years. We're seeing then a 2.5% increase in rents over the next year 4 and 5. And a portion of the increase is going to be in the NOI growth is also by a smaller expense ratio, although it's really not, we're not decreasing expenses that much. So we're increasing NOI by around 24%. That's going to generate at the leverage point a sell price of $29 million. And so that's on a basis of a 6.5 cap, which is going to allow us to really have that outsized return on year 5.
Okay, great. Next question. The reviews for all the properties on both Apartment Finder and Apartments.com seem to be around 3 stars. I presume the team is aware of this and will work on it.
Yeah, so Belmont has a very good track record of turnovers. Ultimately, we got to understand that Apartments.com and other apartment websites are, the audience usually caters more towards the $1,500 to $2,000 a month renter. So this isn't to say that these reviews don't matter. It's the fact that most C-class apartments have this type of rating.
Okay, great. The next question. So the purchase price is $21.3 million, but what is the expected selling price in 5 years?
So we expect to sell at $29 million, and that's going to be on a pro forma basis with the NOI growth. You can see, and I believe I shared the pro forma with you as well.
Okay. Next question. Let's see. In the case of unforeseen issues, and we do a sale in distress, assume 3 years down the line, how are the proceeds distributed? Is there a priority? And then secondary question, is the investment of $100K minimum secured against the real estate asset?
Yeah, great question. So when you have real estate going bad, that means you can't pay the rent. The rent does not pay the debt service. We're already at 2.7, which means we need around 30% of our tenants to not pay rent. That's a pretty big drop, but let's say things go for the worse. One thing that could happen is an additional capital call. Say something happens and we can't get all of our, we know that for the next 6 months, we're going to be in a cash flow crunch. We're going to ask the investors to potentially inject an additional 5% additional capital. This is an example. I've seen this only probably in less than 1% of deals in the market. It's usually people who have underwritten on very thin deals. Right? This is a very fat deal. So on thin deals where you have huge value add and you need to have that happen for it to then accommodate the bridge loan. And so we're not on a bridge loan, we're on a permanent loan, a long-term, very cheap, affordable permanent loan. So a lot of the questions I believe you guys are asking are more targeted towards value add bridge loan assets where you're buying at a 1 DSCR or a negative DSCR, adding a ton of capex, increasing NOI by 60% in the first 3 years, generating a ton of value by that. But if you don't, that doesn't execute on, then you're going to be in a lot of trouble from a debt servicing financing perspective. But you guys aren't guarantors on the loan, so you guys won't have a collateralization against the asset. You guys will be paid first, however, but that's sort of like the worst case scenario. So the more realistic scenario is instead of 12%, you get 8% on average collections. So that's, I don't want to go into too much detail on that because typically what we've seen, we've exceeded all of our cash flow before, but we do want to make sure that we are conservative. So on a capital call, which is optional, we will make sure we understand what we're using it for, how long we'll need this period to be basically bridged. And the only way that potentially might happen is obviously that huge vacancy factor. But if vacancies are going down 30% in this asset, I could imagine the economic scenario of the world in general being very dire, and real estate isn't a vacuum in itself. So I would probably see that as a very minimal risk, although definitely you guys would be first lien holders on the equity. So we would not take any equity beyond only on above that 8% return.
Okay, perfect. Next question. Do you expect to go for monthly distributions ever, or will it remain at quarterly? Also, wire or ACH?
Our distributions will be ACH. You can wire or ACH on the funding. Quarterly distributions is the industry standard, and from an accounting perspective, it's easier. That's likely what the investment will do. But I'm pushing my partners to identify some new tech solutions to accommodate a monthly payout.
Okay, great. Next question. The property purchase price is 21.3 million. 5 years later, is it expected to sell for a net profit of 12.7 million, i.e. 58% of net sale proceeds? However, the cash flow increases only 24% from year 1 to 5. Also, purchase cap rate is 6.3 and exit cap rate is modeled after 6.5%. So the selling price premium should be even less. What is the rationale for a future buyer to buy at such a high price?
Hi, Ranjit. I believe I answered that in the email. So this is funny. If you guys didn't get the email response, then let me know. So this is a pretty standard deal where you see an NOI growth of 24%. That net sales proceeds is inclusive of principal pay down as well. The rationale for a future buyer to buy at such a high sale price is because they can get cheap financing, get double-digit cash flow. High sale price is subjective to where you guys see it now. On a 24% increase in NOI, it's going to be a very affordable and value sale price. Same thing that happened 5 years ago. As long as you execute on the business plan, as long as it has room to grow, and as long as you're injecting capital and improvements to get there, real estate has seen that even in Kansas City, that general growth trajectory.
Next question. Is the 5-year holding period firm? What extension period is planned, if any?
So this is a 10-year term loan. The 5-year period is standard with most of these deals because that's how we get the best bang for our buck. In fact, if we have Meadowbrook, or actually specifically Meadowbrook, if we have an increase in value over the first 2 years based on this turnover premium units, that could be an asset we seek to sell earlier. So we won't necessarily have a need to sell all 3 as a portfolio, although that could generate the best bang for a buck. Selling individually could also be really beneficial. But typically, if we go beyond any periods of beyond the business plan, we make sure that we talk to our investors and we have a supermajority vote to, in any case, we go beyond our limitations.
And then next question. So who are the fees paid to and when? For example, acquisition fees, property management, etc.
Yeah, so the fees are paid to to the general partners and the management. So essentially that's for covering all the costs and time associated with the acquisition, as well as the property management and the asset management. So that's pretty standard, and that's just covering our costs. Right, our profit center is going to be on executing on this deal above and beyond the 8%, and that's going to be, and that's where. So usually for us, it's going to be back-ended, we're not really going to make too much money on the first 5 years of the deal. We're really going to look at executing on this deal. And if we don't execute on this deal at this expectation or above, we're not going to get paid that much.
Next question. Does the year one bonus depreciation offset non-real estate W-2 income, or does it have to be carried over to to future years to offset against only real estate income?
It offset, I'm not CPA, so ask your CPA, but I've talked to 20 CPAs, and it offsets all passive income. Passive income could mean ownership of a business as a passive member, but it definitely doesn't mean W-2 income unless you are a real estate professional or you're married to one. And that's something I've done in the past where my spouse was a real estate professional while I was working at Apple. That has allowed me to pay 0% in federal income taxes for the last year.
Nearing the bottom. So what is the break-even occupancy rate?
So we covered that. That is essentially 69%. And right now we're at 98%.
So the selling price of 29 million versus the purchase price of 21.3 million. The difference is 7.7. However, the net sale proceeds is modeled after 12.7. Then is the 7 million principal paid down in 2 years? First 3 years is interest only.
No, that's, I don't know exactly how your math is coming out from. You're okay. I see what is happening. You're not including the $6 to $7 million of equity that we're putting into the deal. So we're already at $7 million down on the deal. And then you add the 7.7 in difference.
Okay, so last question. The pro forma shows only 320K per year increase in the debt service for the 4th and 5th year. So it looks like only 640K is paid as principal. Is his understanding correct?
Yep.
Okay.
So remember, guys, and I know some of you guys are asking very detailed questions on the pro forma. You gotta factor in the fact that we're going into this with 20%, 23% equity in this property. We're exiting by increasing the NOI by 24%. So that's going to build up on that top end. We're only paying down principal by 640K on the bottom. That's going to decrease it slightly. That big gap is really where the big portion of your equity comes from. That's going to get you that double your money back in 5 years. And we will be providing the recording to this webinar to everyone involved as well. I want to be mindful of everyone's time. And we're already past a lot of time, so I want to say thank you. Feel free to ask any questions. I will be actually providing everybody an interest link in addition to the Zoom poll, so people can see and review that. I will have the subscription docs ready for interested investors by tomorrow. And so if you express interest, let me, please fill out that link, or if you've already told me your interest, then we will be sending you the subscription docs. The next steps after that will be take your time to review it, but then we will send you wiring and funding instructions for funding, and we expect to be fully closed on in the next before September likely. All right. Thanks a lot.
Thank you, everyone.
Guys.